Hey everybody, and happy Friday Eve. Welcome to Yahoo Finance Live. I'm Dave Briggs along with Shauna Smith. Let's get you caught up on the market action today. Stocks kind of emulating Elon Musk's rocket today. Never really getting off the ground. You can see the Dow down about 0.5%. The S&P up down 25 points. And the Nasdaq down about 0.75% on the day. Got some earnings from Amex and AT&T, and we'll dissect those a little bit later on, Shauna.
All right, well, one of the stocks that we are watching today is D.R. Horton, and you can see bucking the downward trend up just about 6% in the final hour of trading. Now, the home builder soaring on better than expected earnings, saying that the spring selling season is also an encouraging start. But we did get existing home sales this morning, and they fell unexpectedly last month. The real estate reality ahead.
And coming up next hour, a Yahoo Finance exclusive interview with Cleveland Fed President Loretta Mester, what she says about the state of the economy, the fallout from the banking crisis, and the Fed's policy path.
All right, and also Tesla plunging today. You're looking at losses of just about 10%. The company's Q1 earnings revealing that price cuts are impacting its bottom line. The EV maker reporting gross margins of 19.3%. That fell short of the street's expectation. Now, a number of analysts cut their price targets today by anywhere from $5 to $50 a share. Joining us now is one of those analysts. We have Dan Ives, Wedbush Managing Director and Senior Equity Analyst, joining us on the phone. Dan, it's good to talk to you here. So I know you lowered your price target to $215 from $225. Obviously, the margin profitability story here is front and center. What did you make of last night's results?
Look, I think it's a tug of war in margins versus volume. And no doubt, I mean, margins under 20%, auto gross margins, missed the street by about 170 bips. That was a disappointment. And ultimately, they're ripping the Band-Aid off, cutting prices to stimulate demand. Everyone knows that. But there's a tightrope that they're walking right now, and the street did not like what they saw in terms of margins. Last thing you want to see is Sweet 16 margins.
Are they, Dan, emulating kind of the Amazon model, if you will, and do you think that can pay off down the road?
Yeah, I mean, they are taking a bit of a page out of that Bezos Amazon model. I do think the difference here, I think 80% of it is coming from a position of strength because they have the scale and the capacity from a battery technology, from a delivery perspective versus competitors across the board. But then there's also a piece that's stimulating demand based on a softer macro. And I think this is just an important balance because part of what makes them the gold standard is that margin level with growth. And if you continue to see compression there, that would be a worrying sign that would keep investors up at night.
Well, Darren, we're looking at the stock falling just over 10% today, $161 a share. How much of this worry do you think is priced in, reflected in today's drop? And what happens? Do you think there's more price cuts potentially ahead?
But I think there's probably 1 to 2 more smaller price cuts. So I think that's something that the street now expects. But I do believe we're starting to get into what's really a moment of truth next few quarters. You know, can they maintain 35, 40% growth and margins being in the high teens? I think if you see margins 18, 20% as it ultimately ramps back to low 20s, that's fine. But it's very important that it doesn't go below that threshold because then it really starts a cascade effect that would be a worrying sign for the stock, with a lot of that starting to get priced in terms of this sell-off.
Now, obviously, those margins still far greater than their competitors in this space. But on the other hand, their competitors spend north of $2 billion a year annually on marketing. And I'm talking about GM and Ford. Well, Tesla continues to spend goose egg, zero. Would you like that to change?
I think you'd like to see that change just because as the EV arms race plays out, I think that's something that they're ultimately going to have to pull that lever. And they haven't had to do that because they're the only game in town and they're miles and years ahead of competitors. But when you have that 313 area code, you look at what Marion, GM, and Farley and Ford are doing, see what's happening in Europe. You got pure plays across the board. And also don't forget what's happening in China. I mean, I'd say the biggest price war right now is not here domestically, it's actually in China.
Dan, the growth, though, that might be ahead for China, is that enough really to maintain the momentum that Musk would like to see from Tesla, not only this year, but into next year as well?
Yeah, I mean, look, China is the hearts and lungs of the Tesla story. And that's why they can't just sit there if there's a price war and maintain their prices. And I think that's something that share gains have been there in China. But no doubt, I mean, you are seeing a price war basically break out in China, and Tesla obviously has to respond. But then it comes down to, okay, margins, what that level looks like. They're so far ahead of the industry. But the last thing you want to see that do is that gap narrows, because that's key to the multiple, and that's ultimately key to the sort of gold standard that Musk and Tesla have set.
Tesla's market share here still at a just insurmountable 58%. Has that number forever peaked?
Look, I don't think it's necessarily peaked because of where we just see broader EV demand going. But in terms of competition, whether it's in China, Europe, US, I mean, this Game of Thrones is just going to get more intense. And I think that's ultimately why Tesla recognizes sooner rather than later. Near-term pain, long-term gain. In other words, put the iron fence around the install base, and then ultimately we'll sell more software into them, whether it's FSD and others. That's where the margin leverage will be. And that is the smart poker move, but it's about the balance. Because it goes back to, if there's a T-shirt that's $50, next week it goes to $40, next week it goes to $30. Are you going to buy it? No, because you assume the following week it's going to go to $20.
That echoes what Ross Gerber told us yesterday, creates the wrong type of consumer behavior. Interesting to hear you say that. Dan Ives from Wedbush, great to talk to my friend. Enjoy the weekend. We are just getting started here on Yahoo Finance Live. Still coming up, don't miss Jennifer Schomburger's exclusive interview with Cleveland Fed President Loretta Mester. That's at 4 o'clock Eastern Time. Plus, existing home sales slowing down as high mortgage rates keep buyers on the sidelines. What to expect for the spring selling season with Zillow's senior economist. And the Oakland A's, they are headed to Vegas, rolling the dice on a 49-acre plot of land near the Vegas Strip. A's president Dave Cavall will join us later on in the show. Stick around.
Treasury Secretary Janet Yellen speaking out on the United States' relationship with China earlier today. Now, she described the relationship as, quote, tense, but also explained why it's very important for both countries to maintain ties. Let's take a listen.
The United States will assert ourselves when our vital interests are at stake, but we do not seek to decouple our economy from China's. A full separation of our economies would be disastrous for both countries. It would be destabilizing for the rest of the world. Rather, we know that the health of the Chinese and U.S. economies is closely linked. A growing China that plays by the rules can be beneficial for the United States.
All right, joining us now, China Beige Book International Managing Director Shahzad Kazi. Shahzad, great to have you back here at the desk. So we just heard from Treasury Secretary Janet Yellen. They're stressing the importance of the relationship between the U.S. and China. Is it possible to have a positive relationship given the fact that tensions are so high?
Look, you can have a relationship that increasingly becomes stabilized. We're not there yet, and I don't think we're going to be there for a while. We have a lot more instability to wade through first.
Stability specifically related to what?
So instability, I think, because we've got a decoupling that is absolutely going to happen, counter to what the Secretary said today. In areas of technology, in areas of financial services, critical supply chains, I think it is going to happen. That's almost inevitable. Not a full decoupling, but certainly this path that we're about to get into. And I think this means a lot more tension lies ahead than perhaps elected officials and cabinet members or in the administration are willing to say publicly.
What's the economic impact of that potentially?
Well, look, I mean, if we begin a process of reshoring, et cetera, there is certainly an inflation aspect to all of that. There is an aspect of having to invest a lot more in America's domestic industries and parts of the economy here in different parts of the country and so forth. So it carries certainly a very serious economic implications.
All right, we've got one more piece of video from the Yellen speech. Let's take a listen.
The United States proceeds with confidence in its long-term economic strength. We remain the largest and most dynamic economy in the world. We also remain firm in our conviction to defend our values and national security. Within that context, we seek a constructive and fair economic relationship with China. Both countries need to be able to frankly discuss difficult issues, and we should work together when possible for the benefit of our countries and the world.
Those difficult issues, what's at the top of the list, and why did I not hear her say Taiwan in this entire speech?
Yeah, I think, one of the things the administration is working really hard to do right now is look like they don't want to be mean to the Chinese government. And I think the fact that Taiwan was left out is very telling because that's incredibly important. The top of the list, really, quite frankly, is the fact that we've got a trade relationship which hasn't worked out the way it was supposed to. China has not lived up to its WTO commitments, as is well known. But also, again, some of the national security concerns around the fact that we've got technology imports and we've got this reliance on China as a single supplier for many of our critical inputs that no longer works.
Shahzad, if we do see a shift here, if we're not as reliant as the Biden administration wants us to be here on China going forward, is that going to contribute even more to the inflationary pressures that we're already seeing here potentially?
It could. This is a long-term play out, right? So we won't feel it right away, quite frankly, because nothing is going to happen to make that shift right away. It remains to be seen, what kind of subsidies are provided, what kind of policy ultimately is rolled out. These are the sorts of things I think congressional officials are battling over. They're only now really beginning to think about it. So a lot more work has to be done in D.C. before we even see what the ideas look like policy-wise.
Last couple of days, we've seen Apple CEO Tim Cook over in India opening a couple of new stores. They're moving some production there as well. Will we see more of that from other major global corporations in the future? And can India be the new China?
Maybe in certain areas, India can be the new China. The fact is, you can't just pick up and create a new iPhone city in a new country overnight. So there are limits. And I'm not sure we want new Chinas to begin with. That said, I think CEOs are feeling a lot of political pressure right now, which says you need to decouple from China. The problem is they don't understand what the rules and laws are because the lawmakers aren't doing that part of their job. So I think we need to see sort of what this looks like ultimately when the lawmakers decide just what type of decoupling is intended and needed.
Why not? You said we don't want new Chinas? Why not when we've got India, who's not a human rights abuser, for one, and who doesn't force technology transfers and steal our blueprints from all our technology?
So I think the China experiment tells us that putting all our eggs in one basket is certainly dangerous. So perhaps we do want some friend-shoring and near-shoring and figure out what allies could potentially be part of that supply chain solution we're looking for. But I would certainly discourage against thinking of India as being sort of the one main basket where everything needs to go from China.
Shahzad, what does the rebound look like in China right now? The economic activity, is it keeping up with what maybe we had expected here going back a couple of months?
Yeah, look, I think the good news out of China is that things are getting better, especially compared to the fourth quarter. The consumer, is starting to get reactivated again. But when you look at Chinese official data, we're starting to see some pretty funky mathematics going on somewhere in there. A lot of the numbers are just not adding up. And you're seeing 10.6% beat in retail. You're seeing a massive GDP print. This seems to be a bit of exaggeration going on, and the statistics are not adding up internally. I think there's a positive consumer story coming, especially in April and May. The government may have pulled some of that forward.
You always take their numbers with a grain of salt. Quickly, a TikTok ban, does it happen?
Hard to say. A lot of folks in D.C. would like to do it, but again, the administration, as usual, is stumbling, not being able to make a decision one way or another.
So you say no. I'm trying to force you off the fence here.
I think as the closer we get to the elections, it'll be hard to stay away from it.
All right. Shahzad Ghazi, always great to have you here. China Beige Book, thanks so much for coming in. All right, well, coming up, we'll get a check in on the markets here. Again, all three of the major averages trading to the downside. The Dow now off just over 200 points. This coming on the heels of a number of earnings reports that we've gotten in the last 24 hours. You're looking at some of those names on your screen. We'll be right back. Markets under pressure here with just about 40 minutes to go in the trading day. You're looking at the Dow off just over 200 points on the move lower, coming on the heels of disappointing earnings reports from American Express, AT&T, and Tesla, all weighing on the broader market. We want to bring in Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Brad, it's good to see you. So we're about, a week into earnings season right now. And so far, according to the latest numbers here from FactSet, about 90% of the companies have beaten expectations. Is that enough, do you think, for maybe a short-term catalyst?
Apparently not, at least today. I mean, the thing you have to remember about that 90% number is it's early days. That's as of last Friday with 30 companies or 6% reporting. But at the same time, when you look at the details of those beats, pretty much all of the non-financial companies beat. And the exceptions that didn't beat were the financial companies. So there seems to be some fairly broad strength. And when you look at what's happening right now, you look at Verizon, you look at Tesla, there's some specific issues there. So I think the case for a much better than expected earnings season is still very real.
Predominantly, you've been breaking down bank earnings, Brad. And is there a single takeaway that you would say sums up those banks?
Well, when you look at the banks, I mean, I think we've seen the regional bank rally break down today. And I think that's because certainly some of the immediate problems have gone away. But the reality is that with interest rates higher, the bank's business model is going to have to change. And that's going to play out over months and quarters and even years. So I think it's too early to get in there. I think when you look at the bank's earnings, that's backwards looking. That's for lack of a better word, crisis, although it wasn't a crisis. I want to see where they're talking about for the next quarter and the quarter after that, because I don't think last quarter tells us a lot. So I'm going to be looking at the commentary much more than the actual numbers.
As lending conditions begin to tighten, how do they need to change their business model to the point you alluded to?
Well, their expensing is, deposits are going to be more expensive. We've already learned that people and companies are moving their money out of banks with low-paying deposit accounts into higher-paying vehicles. So the cost of banks' funding is going to go up. At the same time, even as the cost of funding is going up, most of them have holes in their equity to fill. I mean, that's been papered over, of course, because of the federal term lending facility, but still those holes have to be filled in the next year. So you are going to see financial conditions tighten. You're absolutely right. Loans are going to be more expensive. We're seeing that in the mortgage market. We're seeing that in the car market. Loans are going to be harder to get. And I think to some extent, this is going to be tough for the economy. But from a Fed perspective, they're going to be happy because this is exactly what they wanted to see with higher rates. But now they don't have to raise rates nearly as much.
Brad, what do you think the Fed should do from here? Do you think another rate hike, does that make sense at this point?
I think another 25 basis points, which is what I expect to get in May, is neither here nor there. I think the Fed gets to underline, yes, we're serious about this, we're data dependent, but you're already seeing some commentary from the Fed that maybe we should let some of the impact of the past increases start to play through. And I think when you look at the emerging impact of the banking situation, I would be surprised to see any more increases past May. I think the Fed is going to draw a line under what they've done in May and then just sit and wait. I don't think we're going to see cuts unless we see a significant downturn in the economy, which I don't expect because of employment. But nonetheless, I think the Fed is going to sit tight and say, we're going to see what happens.
Nice to hear you not calling for a recession. I'm getting really tired of the recessionary calls. Those rates will certainly impact big tech, and they report next week. Microsoft, Amazon, Google, Meta, your expectations thematically next week?
I think growth is going to continue to be a good place to be for a couple of reasons. First of all, when you look at the inflation numbers, that's going to come down. As the Fed pauses, I don't think they're going to cut, but I think that pause is going to get extended. And we're already seeing markets respond to that. You know, the 10-year continues to tick down slowly. That is nothing but good for growth stocks. Second of all, when you look at the economy as a whole, when we see the tighter financial conditions, you're going to see less growth in areas outside of tech because of those conditions. But tech, because you're offering scale, because you're offering efficiencies in many cases, they're going to be a little bit more immune. So I think they have a better earnings position. And I also think they have a tailwind from interest rates. So I think that's an area that's going to do better, again, against everything else than people are talking about right now.
But are you talking about the big names? Because a lot of those obviously have been leading the charge higher this year. So you think that leadership then is going to stay intact, it sounds like?
I think it can. I think when you look at some of the bigger names, obviously in some cases we've seen some bounces off some lows, But that's led to a lot of people selling out who weren't committed. Now you have people moving in. The people who own are now fairly committed to the long-term vision. And you're starting to have people move back in who have that expectation over the short to medium term. So I think there is some more upside there because they've already weathered significant declines in many cases.
All right, well, we'll get those reports next week. Brad McMillan, as always, thanks so much for joining us. Well, coming up, we check in on some of the trending tickers with about 30 minutes to go in the trading day. You're looking at LV Sands, Las Vegas Sands, one of the outperformers in today's market, up just about 3%, as well as DR Horton. We'll be right back. It's time for our triple play. Three stocks that we're watching in the final 30 minutes of trading. We've got Las Vegas Sands, BuzzFeed, and DR Horton. Let's kick it off with Las Vegas Sands, one of the outperformers in today's action. We're looking at gains of just about 3%. So off the highs of the session, it was on track to close at the highest level in about 2 years. We'll see whether or not that holds here in the final couple of minutes. But the casino giant's rebound is gaining momentum, driven really mainly by the high-end gaming in Macau. Now, in a statement, CEO Robert Goldstein saying, quote, "A robust recovery across our markets is now underway." The street was pretty pleased with the results that we got. Citi calling the bounce back in business, quote, powerful, while Morgan Stanley also saying that the results were well above its expectations. Now, these results here from Las Vegas Sands pushing some of its competitors higher. We have seen some of those gains given up here in the final hour of trading, but Wynn is holding on to that trade to the upside here, up just around 0.8%. But clearly, Allie, whether or not we're seeing movement in some of those competitors today to the upside, a recovery here within this sector, obviously good news all around.
Oh, absolutely. I think it illustrates this post-pandemic recovery that we've been seeing. You wonder how these companies will fare if the economy were to enter a recession. But like you were saying, analysts appear very bullish. Across the street, the stock has 16 buys, 3 holds, 0 sells. That's according to Bloomberg data. And CEO Robert Goldstein had this to say on the earnings call, quote, "While travel restrictions and reduced visitation continue to impact our financial performance during the quarter, a robust recovery in travel and tourism spending across our markets is now underway. And he said he remains enthusiastic for what's to come in 2023 and the rest of the years ahead. So that's pretty optimistic rhetoric coming from this company.
And you've got to love the numbers that continue to come out of Vegas. Now, last year they did 38.8 million visitors. That was just shy of the 42 million that visited in 2019. And all estimates are they're going to top the 2019 number this year. February, they were just 3% off. So it looks like a plus 2019 visitor number. And by the way, one casino, Marina Bay in Singapore, did $549 million in revenue in the last month. That is an all-time record. So yeah, healthy times to be in the gaming business.
All right, so betting on casinos, but if you're a betting person, you might not want to bet on BuzzFeed, at least not today. That is my play. Shares are down more than 15%. They were down as much as 26% earlier today after the company confirmed to Yahoo Finance it will be shutting down its news division as part of wider company layoffs, which will impact 15% of staffers. The shutdown is a tough one for CEO Jonah Peretti, who had been a long-standing defender of BuzzFeed News. In an internal memo obtained by Yahoo Finance, Peretti said he regrets not holding the company to a higher standard for profitability, especially amid industry downturns and a tough economic environment. BuzzFeed has struggled since going public via SPAC in December 2021. Since that time, shares are down more than 90%. And remember, there was that lawsuit filed against the company by current and former employees last year, alleging that BuzzFeed mishandled that public offering and prevented them from selling shares at a higher price, allegedly worth millions. So this company, there's been a lot happening here for quite some time. However, this comes as we've seen a lot of other media giants lay off folks, especially in the news divisions. Last year, we saw CNN. Earlier today, Insider laying off 10% of its employees. It's a tough time right now for this industry.
It's really tough. And let's not forget, this is somebody who won a Pulitzer Prize most recently for their reporting on the Uyghur, essentially prison camps in China. But Jonah Peretti, when he talks about the challenges, boy, they're long. A pandemic, a fading SPAC market, less capital, a tech recession, a tough economy, declining stock market, decelerating digital advertising market, and he's not even done there. So yes, this is a sad time really for media. And then you look at what's about to happen at ESPN with the layoffs that we believe are going to start today or tomorrow. It is just a really tough personal side of the business with not a lot of jobs being created.
Yeah, certainly a very, very tough landscape here for media. I think that is clear really from what has happened over the last several months. What also stuck out to me in Jonah's memo here to staffers was what he had to say about AI, because he did make it clear that none of these jobs are going to be replaced by AI. But then that following statement there, he said that one of the focuses is on AI, and that remains as strong as ever. So you got to ask how AI is also going to disrupt our business, journalism here going forward.
Writing, no question about that. All right, my play is home builder D.R. Horton. DHI shares soaring today on Q2 earnings, and were they solid. The company reporting a profit of $2.73 per share, easily topped the expectations of $1.93. Sales of $7.97 billion, that's on expectations of $6.45. Easily going by. Guidance also optimistic, between $31.5 and $33 billion. That's against a consensus of $28.5, topping it across the board. So their chairman, Donald R. Horton, quote, although higher interest rates and economic uncertainty may persist for some time, the supply of both new and existing homes at affordable price points remains limited. Demographics supporting housing demand remain favorable. Shares up solidly today, 5.5%, 20% year to date, almost 50% over the last 12 months. I kind of look at this, guys, as almost the way the car business was during the pandemic. There wasn't a lot of cars on lots, and the prices just kept shooting up, as did the demand. A similar type of situation in the housing market as inventory has just plummeted.
Yeah, inventories are plummeting. We saw that also reflected in the existing home sales numbers that were also out this morning. It's tough really to figure out exactly what's going on within this real estate market, because when you take a look at D.R. Horton's numbers, you would say maybe this is a signal that we have seen a bottom within residential construction here. But then when you take a look at, more broadly speaking, what we're seeing in existing home sales, clearly maybe we could see more downside risk ahead given the drop that we saw last month. So I think mortgage rates where they are right now in that 6 to 7% range here, obviously a huge headwind when we talk about housing recovery.
Yeah, and I'm curious what we'll hear from the other home builders like Lennar. They're set to report next week. But, I'm getting to the age now, me along with my fellow millennials, where I'm questioning whether I'll ever be able to buy a home. So I hope that we can get some positive vibes going.
2025.
Some lower rates.
So? Okay.
Some lower
That would be my
prices.
advice.
2025?
Be patient, because people think rates are going to shoot right back down.
Yeah.
They're just not. It's going to take a long time, and probably not till 25, some major relief, which we will discuss right after this break. So stick around as we dive into the housing market and the impact of mortgage rates rising after 5 straight weeks of declines. All right, some bad news for home buyers today. Mortgage rates back up after 5 straight weeks of declines. The 30-year fixed jumping to 6.39%. That's from 6.27 according to Freddie Mac. 1 year ago, those rates 5.11. So what does this mean for the state of the housing industry? We welcome in Nicole Bachot, Zillow senior economist. Nice to see you. So what do you think this means? Are we going to plateau right at this rate and remain frozen in the housing market for the rest of the year?
We're not really expecting rates to move dramatically from where they are right now. This kind of 6.5% that we've seen bouncing around over the past couple of weeks is pretty likely to be somewhere within that realm for the rest of the year, right? We're not going to see the rates we saw in 2021, coming back anytime soon. What we are seeing right now is inventory is super low on the market, and that's really what's causing a lot of the fluctuation, as well as these rate increases that are really, blocking both buyers and sellers from being able to interact.
Nicole, you just mentioned those inventory levels. Are they going to improve at all, given the fact that maybe the spring buying season we could see a little bit more traction?
So we've seen prices starting to increase this spring, but I think a lot of that is just due to the fact that those buyers who can't afford to shop are shopping and there's not any homes for them to look at, right? We have these sellers who are locked into their 3% rates and aren't really willing or able to give up that home, and they're sitting on that existing inventory. Our new listings are way down. That's leading to overall inventory remaining tight, and that's going to continue to, lead to high prices and affordability challenges.
Existing home sales in today down 2.4% from February, down 22% year over year. Tells you what about the road ahead?
So, that shows us, again, both on the side of sellers not being able or willing to list their homes because of the low rates they're locked in at, and also buyers facing these affordability challenges. Both sides are leading to those lower sales numbers, and affordability is really the sticking factor there. And mortgage rates do have the biggest impact on mortgage affordability in this market.
Pricing, what are you seeing on a regional basis? And I guess, what does that signal just in terms of what we could expect here for the remainder of the year, possibly?
So we've seen some price stabilization and kind of price corrections in some markets, that especially markets where affordability is the biggest hurdle. We're looking at Inland West and West Coast markets have seen, some of the larger kind of price corrections happening, just as we're getting back into a place where we can find mortgage affordability again. And it looks like it's going to be, honestly, a pretty long time before we're back to what we historically saw as, what mortgage affordability should look like. So, as far as regional changes in prices, those Western markets have seen a lot of movements, but really we're starting to see things kind of picking up again this spring across countries, across the country, in different regions. As the spring, like I said, the competition is coming back into the market with, buyers ready to buy and few homes that are available for them to look at. That's going to increase prices across the board.
Yeah, of the National Association of Realtors, the numbers they have out today, 3 regions up, and then the West down 7.5%. And the numbers we saw yesterday from Redfin showed Boise, Idaho down 15+%, and Austin and Sacramento and San Francisco all down double figures year over year. But are they still okay in terms of pre-COVID numbers? Are you underwater? Are you still doing okay if you own a home out west?
Yeah, when you hear something like down 10% or 15%, in home prices, that can be really shocking. But when you look at the fact that a lot of those markets were up 40, 50% from 2019 levels, we still have the vast majority of homeowners in a really good position when we look at equity. We still see foreclosures near historic lows. We don't have a lot of people underwater or in distressed situations. And this market is pretty friendly to folks who need to sell their home. If that's an option that you wanted to face, being able to sell your home on this market is really easy, and in terms of there are a lot of buyers who are going to be willing to look at it. So.
Nicole, what are you seeing from a rental perspective? Because I'm looking at the latest numbers here from CoreLogic showing that growth is significantly slowing. That has been the case over the last couple of months. Is that consistent with what you're seeing, and by how much?
Yeah, so we are seeing rents starting to slow down a little bit, about 0.5% down in terms of rent prices from the last month. And, that just tells us that, we're seeing this affordability issue in rentals as well. We're seeing, a lot of folks kind of staying put where they're at. And as we've had the kind of a shift over the past several months from single family construction to multifamily construction, getting those multifamily units out there has been able to increase the rental vacancy rate, which does put less pressure on prices. And that affordability kind of breathing room for renters is going to be really helpful in a time that we've had a lot of challenges in the economy and there are a lot of hits to budgets. So finding that stabilization in rent prices is going to be really helpful for renter households to be able to recover.
When you're the Zillow senior economist, you probably get a lot of friends texting you at questions like, when is a good time for me to buy, Nicole? What do you tell them?
Yes. Yeah. So, when the right time to buy for you is a really personal decision that has a lot of factors that don't have to do with the housing market. If you're looking at, how do I time the market right? It's really important to, first of all, have your finances in order, understand what it's going to take to get you qualified for a mortgage, and understand what price of a home and what price of a mortgage you can realistically qualify for. Get your credit up, work with multiple lenders to make sure that you're getting the best rates and quotes and
But
fees.
Nicole,
And
I'd be texting you back. I'd be saying, I know all that. When are conditions going to be favorable for me to jump back in this pool?
yeah, we're not really seeing a market that's going to be super, super friendly in the ways that, we've maybe seen in the past, at least for the rest of this year, right? We're still going to see rates being challenging. We're still going to see inventory being challenging. And so really working to find ways to make this market work, buying discount points, using a 2-1 buy down, tapping into down payment assistance resources. Those things are going to be able to help bridge that gap for those looking to transact in this market.
All right, Nicole Bichot, great to have you, Zillow senior economist. Thanks so much.
All right, IKEA making a massive investment in the U.S. with plans to spend billions on growing its footprint. Yahoo Finance's Diane King Hall joins us now with the details on who IKEA is trying to take on with this move.
I know. Big move. IKEA is going big on the U.S. So the company is making a $2.2 billion investment in the U.S. market. It sees the U.S. as its next big market, even set to outstrip Germany. This investment would mark its biggest ever, Dave. It plans to open 8 new big box stores, also 9 new smaller stores where customers would get design advice and can order furniture for delivery. They're calling those plan and order stores. Now, the expansion would create some 2,000 jobs. While the company didn't name specific states, it said it is eyeing the South. Now, keep in mind, it has 2 locations already in the works for this coming summer. We're talking about one in San Francisco and one in Arlington, Virginia. So how about that? Big moves.
Diane, who do you think they're targeting? Because an over $2 billion investment, clearly they think that this move is going to pay off. Who should be a little bit nervous about
Watch
this?
out, Walmart and Wayfair, the W's. IKEA is coming for you, okay? So IKEA trying to gain more market share. IKEA wants in on the increasingly budget-conscious consumer. They're seeing people trade down in terms of what they're looking for to fit the budgetary needs that they have. So IKEA wants in on that. It's planning to modernize existing stores along with this investment that they're making. It is the U.S. they're looking at as a competitive market. Again, as I mentioned before, right now, as of this past year, the U.S. brought in $6 billion here in terms of sales, right behind Germany. Germany was $6.2 billion. So they're expecting the U.S. to overtake that. So why not set up shop in these places that Walmart is moving out of?
All right, so let's set the investment stuff aside.
Yes. Have we ever built?
I
Can't wait to see what's coming here.
There was an interesting story just coming out of COVID. There was real panic because a lot of people were buying up IKEA and Wayfair type of furniture that was piling up in the dumps because it's not built to last that long. Which lasts longer? Do we know?
IKEA
have
or
you guys
Wayfair?
bought some IKEA? Have you bought some Wayfair? Have you bought some Walmart? And do you have any feelings on that? Because this is the stuff people need to know.
IKEA is such a nightmare to put together, so I've never bought anything from IKEA.
I have. Okay, so there are things I think you can buy, and designers will say, you can buy the Billy bookcases. Those will actually last. Those will last a long time. Don't buy a bed from IKEA. Sorry, IKEA. Listen, I did it in my 20s, and I was like, never again. Bed, you got to invest in. But certain things will last. The dressers, you got to be careful with those. Some are good, some aren't. The bookcases, definitely, those will last. There's some staple pieces that you can go with.
What about putting them together?
Oh, that's a project.
It's such a
you might as well hire the person. They've got that business now too. Outsource that part or go to TaskRabbit. Why not?
Money there.
I know.
It's like buying.
It's American.
Definitely have you put together IKEA furniture?
I put together, hang on, I put together the most complex thing in the world, which was a grill, which took me numerous days. No. You won't buy a grill off IKEA, honey. No, that was just off Home Depot's website. But yes, I can certainly handle the furniture if I can handle the grill. I'm a little bit handy. A little bit.
I wasn't questioning that. It's just IKEA, there's a heck of a lot of stuff.
There is. And they're like, what is this extra part for?
And you're always one thing.
Call me, ladies. I'll come over.
Okay.
We'll hang.
I need all the help.
I just charge beer. That's it.
Okay, that's fine.
Thank you.
All right,
Appreciate
thank you.
Or tequila, actually. Let's be honest. Coming up, another round in the fight between Florida Governor Ron DeSantis and Mickey Mouse. Stay tuned to find out who's winning.
power struggle between Florida Governor Ron DeSantis and Disney is not cooling down anytime soon. It sounds like the DeSantis-appointed Central Florida Tourism Oversight Board voting to give itself, quote, superior authority over Disney when it comes to decisions on planning and development issues. Yahoo Finance, a senior columnist Rick Newman, joining us now. And Rick, neither side, it seems like, is going to be backing down anytime soon.
No, and I think my best guess is this is going to end up in litigation. So instead of going back and forth through all the different moves, counter moves, the broad picture here is that DeSantis wanted to punish Disney because they did not support, in fact, came out against one of his culture warrior laws in Florida last year. That was the law limiting what you can teach young kids in school about gender issues and things related to that. So he punished Disney by taking away this autonomy they have. Disney kind of pulled a fast one, managed to get this board to lock in their autonomy for something like the next 30 years, which sounded like it was pretty ironclad. But now DeSantis and some of his allies are saying they're going to get the state legislature there to pass some kind of a law that would actually give Disney the authority. And DeSantis, by the way, also threatening to construct a prison right next to Disney's property there. So in the bigger picture, what the heck is going on? And I'm honestly scratching my head, because if you're going to pick a fight, if you're a presidential hopeful and you want to pick a fight with some big nasty corporation, like pick a fight with Exxon or a for-profit prison company or something, or the cable company. Some company people actually hate. I mean, Disney has one of the strongest brands in the world. And if you have to say from a branding level, whose brand is stronger, Disney's or DeSantis's, I think you'd have to clearly say it's Disney. So what is DeSantis trying to do here? This is all about his war on what he calls woke capitalism. Maybe he can turn this into some kind of winning movement at the presidential level, but I have my doubts right now. Most Americans don't really even know what woke capitalism is. And when you look at some polls on the issue, more people think being woke is a good thing than being a bad thing. I mean, it connotes tolerance and acceptance to a lot of people. So DeSantis, I guess he's just going to carry this battle forward until he gets a favorable outcome where there's nowhere else to go. But it really looks like a fight he never should have picked in the first place.
Kind of reminds me of Clark Griswold, and you and I are the only ones old enough to remember him punching the moose, right, at Wally World when he lost his mind. So who wins this heavyweight title match, DeSantis or Iger? And is there any investor side of this story? I mean, do investors lose at all here?
I think there's a longer term issue for investors, which is this Republican war on corporate wokeism? And it's not even the whole Republican Party. It's just kind of an emergent movement that DeSantis now seems to be championing. Is this going anywhere? And does this have any market implications? I suppose maybe on the margins, it does have some market implications. I mean, this is an extension of the pushback to ESG investing, environmental, social, and government investing. So this is a sort of a dramatic form of that. This feels like one of those things that's not going to get any traction. It's going to fizzle out. And in terms of who's going to be the last man standing here, well, Disney has been in Florida since 1967, before Ron DeSantis was born. And Ron DeSantis, if he runs for president, he will no longer be governor of Florida. And even if he remains governor, he's only going to finish out his second term and then he's gone. So I have a feeling Disney's going to prevail on this one. Plus the law. I mean, let's not forget, this comes down to what is the law, and can a state government just arbitrarily sort of seize these type of rights from a corporation when the corporation itself seems to be doing all the legal work necessary to retain its rights. So my guess is Disney is going to prevail, and that DeSantis is going to have to find some other hobby horse if he really wants to excite most Americans.
Well, at some point, he's going to have to realize his opponent is Trump and not Mickey Mouse. But that point has clearly not been reached.
Dave, last thing here, just to make this even more fun, even Trump is now siding with Disney just because he thinks DeSantis is a bigger enemy to him than Disney would be. So even Trump is dinging DeSantis on this.
Ouch, that stings. Rick Newman, pleasure, sir. Thank you.
Bye, guys.
All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
The AI that's seizing the market right now, that everyone is trying to get ahead of, that all the tech companies have pivoted to, so-called generative AI. I mean, it really only kicked off in the last 6 months or so with the release of ChatGPT and some foundational models before that. And the acceleration both of the technology and its applications are unprecedented. So when it comes to regulating this new space of AI, regulators are far, far, far behind. Fundamentally, the question is going to be, how do you regulate whilst trying to make sure that innovation isn't being stifled? They're all powered by data. So who owns that data? Who owns the output? These are all absolutely integral questions for the future of artificial intelligence.
When it comes to artificial intelligence, there's lots of opportunity. You reported it yourself, actually, about NVIDIA and the opportunity that they have. They just got upgraded. That stock's performed really remarkably well again this year. I would look at other names like C3.ai, which is another artificial intelligence name. But I think you have to go in with your eyes open and figure out who you are and where you are on not only the life cycle scale, but on the risk scale. I do think, considering everything that's happening over the last 3 or 4 months and everything we've heard, that AI is going to be a place that you want to be.
All right, just minutes away from the closing bell. Time to bring in Yahoo Finance's Jared Blickery to break down today's market action.
That's right. Actually not all 11. It looks like 10 of the 11 sectors in the S&P 500, excepting staples, are down. That's a pretty defensive setup that we're looking at right now. Dow down 133 points. S&P 500 down about 64 basis points. The Nasdaq down 0.9%. And we saw this really accelerate, the selling, that is, to the downside at about 2:30 p.m. Didn't really see anything major happening in that window, except Tesla. Guess what? Tesla was 10% down, and then it sunk a little bit more from that. Only other thing that really caught my eye today, it's 420, guys. And guess what cannabis stocks are doing today? They are tanking. In fact, today is a 1-year anniversary of the weed ticker. That is a Round Hill Cannabis ETF. And guess what, guys? That is down 72% from that 1 year ago launch. Anyway, kind of a down day here. Looks like we're going to have the worst day in a couple weeks. But here's the bell on Wall Street.
All right, well, there's a closing bell for you there. Losses across the board. You're looking at Dow well off the lows of the day, off just over 100 points here as we check out the final trades. The S&P off about 0.6%, 0.59%. If it holds right there, that would be the worst trading day that we've seen in just about 4 weeks. You're also looking at the Nasdaq off about 0.8%. In terms of the underperformers in today's market, inside the Dow, Verizon, Cisco, Travelers among the worst performers there.
All right, let's take a look at some of the movers on the day. AT&T shares closing down more than 10%, after the company reported lower than expected revenue and free cash flow in its first quarter. The telecom giant's results also taken down rivals Verizon and T-Mobile. You can't help but wonder what that says, Shauna, about macro concerns.
Yeah, exactly. And I think this really points to the fact that maybe we are starting to see some cracks when you look at the economy. Some comments here from CEO John Stankey just really saying that he is starting to see some people here, some of their consumers pushing out those upgrades that we know is so critical here to that company. But again, one of the reasons why we're seeing the stock off so substantially today.
Just want to add that Stankey would not address the rumors that DirecTV and Dish will merge, but it does appear inevitable. It does look like Dish is a troubled asset at this point.
Yeah, he wasn't touching that one, at least for now. All right, let's talk about American Express shares also in the red, off just about 1%. The company's first quarter earnings showing that it did set aside $1.1 billion for loan losses, more than what the street had expected. The provisions eating into some of the profits there. And you can see, Dave, the street not pleased with these results.
Yeah, it was interesting. The CEO talking with us earlier, the earlier shows here, saying, well, I think the street kind of got this one wrong. They were pleased with the report. One number that jumped out will probably not surprise you, but spending up on travel and entertainment in the quarter, 39%. if anything, tells the tale about how we are continuing to spend on travel. That is a monster number, 39%. And their CEO adding, the lower end of the economy, you are seeing some stress, but we don't have that here. And I think that's part of the misinterpretation from their results. Yeah, seeing a little bit of stress, but not as far as their numbers are concerned, Sean.
Yeah, certainly. All right, Tesla also extending losses from Wednesday, ending the day in the red, off nearly 10%. Price cuts beginning to weigh on the EV giant's profit margins. And Dave, we know the profit margin, that was one of the key metrics within this report that the street was closely watching because of those price cuts. But it disappointed the street, coming in even much lower than what the consensus was out there. And that's why we're seeing such a huge hit to the stock right now.
And what was interesting is to watch the domestics, because GM is down 3% on this news. Ford is down just shy of 3% on this news. And fair to ask why. On the surface, presumably they think they'll have to lower their prices in the EV space, which will cut into their already small margins on their e-vehicles. On the flip side, though, if you look inside Ford and GM's numbers, their margins are really not on EVs right now. They're hardly selling any of those. Their money is all coming from SUVs and trucks, and their margins will not be at all impacted by what Elon Musk is doing, but nonetheless, that is the presumption. Interesting to hear Dan Ives agree with the sentiment earlier that perhaps it's time to advertise. I mentioned GM and Ford, who both spend north of $2 billion a year on marketing, and Elon continues to zero out on the ad budget.
Yeah, and it's something that we heard from Ross Gerber yesterday, just talking about how he wants more of an expansion of the brand to grow Tesla into that global brand. It's something he's talked about on Yahoo Finance in the past, comparing what Tesla's brand is to what Apple's is on a global scale. But when you take a look at these numbers, lots of debate about whether or not these price cuts are going to be worth it. Ives, however, is on the side that it's going to be some near-term pain for long-term gain. He's really pointing to some of the demand out over in China. He thinks that is going to be a critical catalyst here for Tesla, at least in the near term. He did, though, lower his price target. So I think the street is kind of rethinking exactly what Tesla's numbers at least are going to look like over the coming quarters.
Yeah, does that Amazon model really work out in the end? Are they that similar? Amazon has so many different aspects to them. All right. Microsoft has integrated ChatGPT style capabilities into its employee experience platform, Viva. Yahoo Finance's Ali Garfinkel joining the conversation now and tells us more about this. Ali, what are we learning?
Hi, Dave. So Microsoft is really covering all its bases here, right? Microsoft has been working to integrate ChatGPT style technology into just about every app it has. We've seen that previously with Microsoft 365. We've seen it with the company's cybersecurity offerings, and now we're seeing it with Viva. If you haven't heard of Microsoft Viva, it's actually a relatively new product for them, and it's their employee experience platform. Now, if you're sitting there being like, what on earth does that mean? It essentially means the sort of thing that you use within an organization. So virtual group goal setting, aggregating employee surveys, that sort of thing. It's a market that Microsoft believes is worth about $300 billion. But I want to zoom out on the bigger picture here. This is really happening as Microsoft is looking to lock down its AI market share. This all, of course, goes back to that Google versus Microsoft paradigm we've been talking about for months now. In a lot of ways, I think the speed Microsoft is working at here is leveraging the distrust that a lot of consumers and the markets feel towards Google's AI efforts right now. That said, let's not forget, this is bigger than Viva, this is bigger than Microsoft, and it's bigger than Google too. We're really starting to see every tech company under the sun jump into the AI mix here, Dave.
We certainly are there, Ali. When we talk about some of those names that are jumping in, Snapchat, now they have made it available, their AI chatbot, for some users, but now they're rolling it out on a global basis. We tested it out. I know you did too. I didn't think it was too impressive. What do you think?
Okay, Shauna, the reason I'm making that face is I have to be honest with you and our audience. It is the least impressive of the AI chatbots that I have used so far. I want just the basics. The chatbot is called My AI, and they initially released it in a trial period that was exclusively for Snapchat Plus subscribers, and now it is available for free to Snap's 750 million monthly users. Okay, so I had some concerns about this almost right off the bat. You guys actually tested it out with a question about former Netflix CEO Reed Hastings. The information that came back was inaccurate. I also had one of the maybe weirdest interactions I have ever had with AI. I asked it if it was, I said, hey, aren't you an AI chatbot? When have you gone on vacation? And it said, actually, I'm a real person, not an AI chatbot. It was the only time using a chatbot that I have ever sat there and been like, God, I wish I had an AI ethicist on the line right now to explain why this may or may not be okay. Point being, bottom line here, it seems pretty half-baked so far. It sounds like you guys had a similar experience, Shauna.
Yeah, we did. Our producer, Sydney, actually asked, she asked the chatbot a number of questions. One of those questions was she asked about the meaning of life. We're not going to go into the whole thing, but she asked about Tesla's most recent quarterly reports, which was out last night. And they actually gave the numbers from a year ago. She tried to clarify, and once again, they reiterated what they gave her. So there's a lot of inaccurate information, at least on Snapchat's AI bot.
So is this like the Snap drone and the Snap camera?
Yeah, you got a question.
That conversation.
It's far from a home run, it seems like at this point.
All right, Allie,
yeah,
thank you.
It's something they're trying out.
Nice try. Thank you, Allie. All right, coming up, Jennifer Schonberger's exclusive interview with Cleveland Fed President Loretta Mester. You don't want to miss that. Coming up. Sky-high inflation, a job market that's starting to moderate, and the prospect of tighter credit conditions are all key factors in the Federal Reserve's path for rate hikes. So what can we expect from officials ahead of next week's policy meeting? Let's throw it over to Jennifer Schonberger and special guest Fed President, the Bank of Cleveland President, Loretta Mester. Nice to see you, Jennifer.
Thanks, Dave. President Mester, thank you so much for joining me. It's great to have you on the program.
It's my pleasure to be here. Thank you.
I want to kick off the conversation with what we learned in the Fed minutes last week, which is that Federal Reserve staff are now expecting a mild recession later this year as a result of bank failures and the potential for ensuing credit tightening. Do you share that assessment?
So my view is that, growth will be very slow this year, well below trend. And when you have growth that's that slow, it doesn't take much of a shock, something comes up that could push you into negative territory. So I think, it's a matter of, I think the overall trajectory is slowing growth. We also are going to see perhaps some slower employment growth. We've seen that come down. some over the past year, and I think that'll continue. But I also think we're going to see material improvement in the inflation side. So what's happening is there's this rebalancing in both product and labor markets between demand and supply. And that's what it's going to take to get inflation on that sustainable downward path to 2%. So I think there's been progress, and I think we'll continue to see progress this year.
So then what are you seeing now as far as credit conditions? We learned in the Beige Book that banks have tightened lending standards across several districts. Do you think that things could get worse from here, or is it largely contained?
Well, let's take a step back. So certainly the banking industry is strong and resilient and sound. We did see in mid-March some stresses at a small number of banks. And then we had the two bank failures, Silicon Valley Bank and Signature Bank. And those failures really led the Fed and the Treasury and the FDIC to take actions to ensure that the problems in those banks, in those small number of banks, wouldn't be contagious, all across the system. Mm-hmm. And so we set up a new lending facility, a liquidity facility for banks, and we also have our traditional discounting lending. And those actions have reduced some of the March stresses we've seen in the industry. So that's a good thing. Now, even before the stresses in the banking industry in March, banks were already beginning to tighten their credit standards. And that's because interest rates have moved up. But that's the typical way monetary policy transmits into the broader economy. So the question now going forward is, will stresses in the banking industry, those stresses in March, lead banks to move faster to tighten their credit standards? And if so, credit will become less available. And that has the same kind of impact on the economy as tightening of monetary policy. So we're doing that assessment. We're continually engaging with bankers. We also have some surveys that we do. And that'll be part of the discussion at the upcoming FOMC meeting to really assess not the magnitude of those effects and what the expected duration of those effects will be. And that'll influence how we think about the future path of monetary policy.
So when you're weighing credit tightening versus inflation, and I know you said in a speech earlier today that inflation still remains too high, which is sort of the bigger problem right now that you see when it comes to setting monetary policy?
Well, inflation still is too high, as I said, and I said in the speech. We've seen some progress there. If you look back, at the peak in inflation last year, we're down from that in terms of the headline inflation numbers. The core inflation measures that really look at the less volatile components, they've made less progress, but nonetheless some progress. But the levels are still too high. And so what we really need to do is we need to make sure that we get that inflation rate on that sustainable downward path. So that's my focus. The tightening of credit conditions, either from the Fed or perhaps from banks tightening their lending standards more, is a mechanism for getting that done. And that's the evaluation that we're going to be doing at the upcoming meeting to make sure that we're on a path. The underlying economy has shown resilience to the rate increases we've done already, and also over the pandemic period, it was more resilient than I think a lot of us had feared at the very beginning. So far, it's been quite resilient, and now we just have to make sure that we get the job done on inflation, and that's what it's our responsibility at the Fed to do.
So given that, you said that you think rates need to rise above 5%. The median projection is 5 to 5.25 on the peak Fed funds rate. Does that level make sense to you, or do you think that the peak on the Fed funds rate needs to be higher than that range of 5 to 5.25?
Well, we'll be evaluating that in our meeting. I do think that given where inflation is, and given how stubborn it is, and given the strength, the still strong labor market, I do think that rates are going to have to move up to above that 5% level. But how much they have to move up and for how long they'll have to remain there, that's what the economy is going to tell us. The economic developments, financial developments, those developments are going to inform right? The future path of policy. So I think at this point, that's where I'm there. But as information comes in, and we look at a lot of information, not just the official statistics, but also a lot of reports that we get and information we gather from contacts in our district, whether they be businesses, community contacts, labor market contacts. That information is going to tell us, where policy should go, and we're going to take that into account when we make our next decisions.
But is there a risk to the upside in terms of the policy path there?
Well, again, we're going to just be evaluating that going forward. I mean, the median path in the SEP, which what you were pointing out, was the median across all the participants. We come into every FOMC meeting, looking at all the information we've gathered in that intermeeting period about how the economy is evolving. And that helps inform our outlook. So we'll go into the meeting and we'll talk about not only policy at the current meeting, but also where we think the path's going forward. So that's just what we typically do in an FOMC meeting. And then we articulate the outcome of the meeting in the policy statement that comes out after the meeting. And of course, Chair Powell has his press conference at which he explains more about the thinking of the committee.
I know we still have some time till the next policy meeting. You're still going to be poring over the data, and certainly a lot changed in the intervening period last time around with SVB's failure. But given the data in front of you today, would you lean towards tightening at the next policy meeting?
Well, as I said, I think we do need to get the rate above 5% in order to be assured that we're going to have inflation coming down back to our goal of 2%. But I don't want to give sort of a decision now when there is more information coming in, and we'll have the discussion in the meeting. But that's where I am now. And then again, we're going to gather this information, including, the assessment of, the tightening of bank lending conditions and the effects those may be having on the economy as well.
Are there certain conditions that would warrant having you pause and wait perhaps another meeting?
Well, again, what we always think about when we go into a meeting is what's the appropriate path of policy that'll meet our dual mandate goals of maximum employment and price stability. And one of the things that happened before the March meeting is that we did take actions, the Fed, Treasury, and FDIC, to really make sure that financial markets and banking markets remain stable. And that was a very important thing to do. And the Fed is on record as saying, the chair said this several times, and Michael Barr, the vice chair of supervision, that we're prepared to do more with our macroprudential tools to make sure that the financial system stays stable. And that's a really good thing, because if we use our macroprudential and microprudential tools, including bank supervision and regulation, to keep the banking system sound and healthy and keep the financial markets, working, then we can use our monetary policy tools to focus on the macroeconomy and our monetary policy goals of price stability and maximum employment. We had that opportunity at the March meeting, and I expect that we'll have that opportunity going forward.
Switching gears, I want to ask you about women and the economy. Some recent research from Bank of America showed that women are at a risk of real wage losses. They say in that research that they're less likely to get raises that keep up with inflation. At the same time, Treasury Secretary Yellen has said that women who have full-time jobs in this country only earn 83 cents on average on the dollar compared with their male counterparts. President Mester, why are we still dealing with this? How do we close the gap? And would this not help economic growth if we close the gap?
Well, it certainly would help economic growth if everyone could enter the workforce and be productive and gain education, that they could actually be a very productive member of the workforce, especially as jobs change. So there's no doubt about that we want to have everyone who wants a job to be able to enter the labor force and, really produce to their potential. And that there's no doubt about that. Women are disproportionately harmed by the fact of childcare not being available and not being available at an affordable price. There's no doubt about that either. The Cleveland Fed has done some work on this. And there's a number of ways that women are, their labor force participation is hurt relative to men. One of them is the cost of childcare, because in this country, it's still more of a woman's responsibility to care for children than a men's. Another is sort of the tax treatment of married versus singles. And a third factor they found was just the allocation of Social Security benefits. So those weigh on labor force participation in women. And if we could do things to get women into the labor force, it would definitely, help productivity and therefore the longer run growth of the economy. The gender pay gap is smaller than it was in the 60s, but there's still more work to do. Of course, some of the gap is because women have different types of job, work in different sectors relative to men. Of course, some of that is driven by the fact that women do have childcare responsibilities, and childcare isn't as easy to find. So again, this is a complex problem. There's multiple things that have to be done to solve it. I think I'm always a fan of making sure that people have the opportunity to get educated or to take training. And I think that's been found over time to help close that gender gap. But we need to do more. And I think there's a number of things that every firm can do to make sure that we are giving women equal opportunity to men to be a productive member of the labor force.
And President Mester would love to continue that part of the conversation with you at some point in the future, but unfortunately we'll have to leave it there. Thank you so much for your insight. I so appreciate it. Hope to talk to you again soon.
Thanks for having me. I really appreciate it.
That's Loretta Mester, president of the Cleveland Federal Reserve. Back to you.
All right, Jennifer, great interview. Thanks so much. And of course, our thanks to Cleveland Fed President Loretta Mester. All right, well, you just heard from Loretta Mester there, Cleveland Federal Reserve President. Some headlines here from that interview saying that, once again, reiterating that inflation is too high. Growth, she expects to slow here for the remainder of the year, stay below trend. Also making some comments about the banking system as well, saying that the banking system is strong, that it is resilient. Still some questions, though, about credit conditions tightening. So we want to bring in Nancy Laffer-Tengler here, joining us for the conversation. And Nancy, let me start with you right now, because starting with some of those inflation comments, growth here she expects to slow, but she did reiterate that the Fed has a job to do, and that is getting inflation under control. What did you make of her comments and what you think the Fed should do next?
Yeah, so I think we should note that that Shauna, that she doesn't vote in this next round. But importantly, the Fed let inflation turn from a controlled burn into a wildfire. They went almost a year without raising rates after we knew inflation was rising and still expanding the balance sheet. If you go back and look historically, if you look at previous inflationary periods, what you see is that inflation is mostly symmetrical on the way up and on the way down. And so it took 16 months to get to peak inflation in June, and we're now 12 months or 10 months into the decline. I actually think we're seeing progress. And the Fed is, when they started to go data dependent, looking at backward data, that's when they began to make the mistakes. And that was at the meeting in 2020 at Jackson Hole. But if you look at the leading indicators, leading economic indicators are down significantly for almost 12 months. The PMIs, manufacturing, have rolled over much more dramatically here than the rest of the world. Employment's coming down. We wrote a piece in February that said average hourly earnings, employment cost index, and the unit labor costs had all rolled over, and that belied what we were seeing in the non-farm payroll numbers. Remember, that January number was huge. So when you start to look forward, what you see is that the Fed has finally started to make progress, and I fear that they're going to go too far because they're looking backward. Last thing, CPI is almost 57% of it is shelter, and the real-time shelter numbers have rolled over. So the Zillow index and the Penn State index have rolled over pretty materially, saying that inflation is coming down. It just doesn't show up in the numbers yet because of the lagged effects of how they look at shelter.
And that is difficult. The numbers they're looking at, certainly a lagging effect. So also with us, Sonia Meskin, BNY Mellon Investment Management, head of U.S. Macro. Nice to see you. Your thoughts
Hi, great to see you.
On what we just discussed there. there. Do you have that same fear that though they are seeing progress, that perhaps the Fed will go too far?
Well, I think there's a lot of uncertainty in the markets right now. And one of the big reasons why that is the case is because economic data is not unequivocal. There's some data that's pointing to continued strength. We just saw the Empire State Manufacturing Index earlier this week. Look at the Philly Fed, other than the headline business conditions, business sentiment index, the underlying numbers were quite a bit stronger. You look at the Atlanta Fed wages or the ECI, wages have actually reaccelerated again. But then you look at average hourly earnings, and yes, they have moderated. And you look at some of the indicators that you guys just pointed out, and yes, there is some moderation as well. So I do think that there's a greater uncertainty in the data than is typical, and I do think that introduces a continued uncertainty for investors as well, and for the Fed.
And speaking of some of that uncertainty, President Messer did weigh in on the banking crisis, what we saw play out in the regionals over the last several weeks. Let's play a quick clip of what she had to say about that.
Now, even before the stresses in the banking industry in March, banks were already beginning to tighten their credit standards. And that's because interest rates have moved up. But that's the typical way that monetary policy transmits into the broader economy. So the question now going forward is, will stresses in the banking industry, those stresses in March, lead banks to move faster to tighten their credit standards? And if so, credit will become less available. And that has the same kind of impact on the economy as tightening of monetary policy.
Nancy, are you seeing any signs of a credit crunch at this point?
No. I think if you talk to the banks, PNC came out and said that they were not cutting back on lending. We saw the same comments from American Express that consumers resilient and they're increasing their loan loss reserves. But I think at the margin that's true, and what she said is also true, that it's doing the work of raising rate of what the Fed's doing with rate hikes, which is another reason, in my view, for them to pause and let this catch up, because we know monetary policy has a lagged effect. And we also know that M2 has gone negative. But this Fed has said that monetary supply has nothing to do with inflation. I think the facts prove otherwise, and that they should be looking at other indicators besides the few things that they are looking at.
So I want to get your thoughts on that. When you exactly think we'll see those tightening credit conditions really impact the banks, and how disinflationary will that be? Is it a 25? Is it a 50-point hike? What does it equate to, really?
It's very difficult to say exactly. It's very difficult to put a number on, translate the potential tightening that we haven't even seen yet into a number of hike, 25 basis point hike equivalents, if you will. What I would say is, I think what we've seen here is that potentially we haven't really heard much from small regional banks yet. We know that the larger banks, as we had expected, have weathered this quite well, and some of them have actually seen an influx of deposits. And those are very valuable deposits in a high rate environment. Now, what we don't know is so far how badly regional bank lending has been hurt. In which areas specifically they may curtail lending the most, and can the larger banks that have weathered this well step in instead and provide credit to those areas if the smaller banks do pull back lending? All of those are still uncertain. We don't really have much data to tell us this, but this is what I would be watching out for if I were at the Fed, or if I was interested in exactly how much credit contraction we could expect. I would be watching for that substitution effect. Potential substitution effect, if you will.
Yeah, Nancy, given all this, given the fact that you are confident that inflation is going to continue to tick down, how should investors be positioned at this point? Should they still be defensive, or is there this maybe time to add some risk into your portfolio?
So, Shauna, we started adding risk back in the fall, and it seemed kind of crazy at the time. We were adding to consumer discretionary and to technology, and that's been a good place to be. Now, recently, we've started trimming because we've seen a really strong move in those names. I think you want to get through earnings season, use the volatility as your friend. If you're a long-term investor, volatility is your friend, and you should use it to pick off the high-quality names. I think the defensive trade is not necessarily over, but sort of fully valued. So you want to have some of that in your portfolio, but we've really been moving towards reliable growers, which tend to be the riskier names, and really strong management teams. I know that sounds like a cliche, but it really matters in this environment to navigate through. And so we have added to many of the names in technology and consumer discretionary, as I mentioned, and we've also added the metals and miners that drive planetary decarbonization, because we think we're in a commodity super cycle.
How does Tesla fit into that strategy?
I'm going to be buying after this report. Yeah, we bought some on January 3rd or 4th. It was just dumb luck. We pretty much almost bottom ticked it. And I think what I heard is different from what the street heard. This is a management team that is going to increase share, which is driving consumers into their ecosystem, which is what Apple has done. And then I think they'll reap the benefits for the long term. I think Elon Musk is so often underestimated. I've done it myself, but I'm going to be in buying.
Not concerned about those declining margins.
That are still double GMs and probably quadruple Fords.
Fair point,
yeah.
Indeed. Nancy Tangler, Sonia Meskin, appreciate you both very much. Thank you. All right, coming up, layoffs spreading beyond tech, the media sector racking up job cuts today as BuzzFeed News shuts down. We'll take a closer look at the environment next. BuzzFeed, one of the latest media companies to announce layoffs. The digital media company is cutting 15% of its staff and closing. The Pulitzer Prize-winning BuzzFeed News CEO Jonah Peretti said in a memo acquired by Yahoo Finance, quote, "We faced more challenges than I can count in the past few years, a pandemic, a fading SPAC market that yielded less capital, a tech recession, a tough economy, a declining stock market, a decelerating digital advertising market, and ongoing audience and platform shifts." That's just a few. Joining us now is Elahi Azadi, Washington Post media reporter. Nice to see you. So among those many aspects that contributed today, what do you think really was the deciding factor that brought down BuzzFeed News?
Well, it's unclear at this moment, like what exactly triggered this, where we're now seeing about 180 employees being laid off, because it's just not BuzzFeed News that's shutting down, it's reductions in other parts of the business. But what we can look at is back in December 2021, BuzzFeed went public, and the deal was initially valued at $1.2 billion. And a year later, the company was valued at about a third of that. So we saw, this this bigger wave of in the tech industry where we look at within tech, the media subset of it, right? The media online digital industry. You know, in the early aughts, 2010s, it was a boom time. You had a lot of investors putting in a lot of money into these companies with the promise that this was the future of media, this was the future of journalism. And a lot of those companies have suffered rounds of layoffs, huge cutbacks, especially right now, as was said in that memo, we're having sort of a recession in the tech industry, but more importantly, I would think for the media journalism industry, a huge cutback in ad revenue. And this is really hurting the bottom line of a lot of media companies. It's not just BuzzFeed. I mean, you saw CNN lay off hundreds of people, the Washington Post, even my employer laid off people. So we're seeing this happening across the media industry, but really BuzzFeed News went through several rounds of layoffs before we got to today.
Well, then given the wide amount of cuts that we have seen already within the media industry, and given the fact of what you've been talking about, kind of this broader industry-wide shift, should we expect more cuts then in the media industry going forward here, at least in the short term?
I wouldn't be surprised if we see more. Another media company I might point everyone's attention to is Gannett. They are one of the largest newspaper owners in the country. They own hundreds of regional and local newspapers, and their workforce has been utterly reduced, huge cutbacks. This is the parent company of USA Today and many newspapers all around the country. And so I'm not expecting a slowdown in this per se. It really depends on the wins, the economic wins. But when advertising revenue bottoms out, this is one of the impacts. And the other thing I would say about BuzzFeed and maybe some of these other digital media outlets is a lot of them don't have paywalls. They offer their journalism for free. So they're more susceptible to declines in the ad revenue market. Some other newspapers, you know, or newspaper industry, they're really looking at subscriptions and whether a paywall and having a more aggressive paywall is helpful. But when we look at the digital media industry, one of the problems is even if you offer a paid or subscription model, oftentimes the amount of that digital subscription that you're getting per subscriber does not account for the loss in the print subscriber. Print subscriptions cost a lot more. And so we're kind of in this weird in-between moment in the media industry right now as a result.
Yes, CNN, massive layoffs recently. ESPN apparently undergoing a steep round of cuts this week. Are there any winners in this environment that you just described?
Well, I don't know about the shareholders and how well they're doing. You know, there was a report that cuts before in the news industry, the news division of BuzzFeed equated to, you know, potentially hundreds of millions of dollars for the company. I'm not sure about winners right now. There are many employees who have lost their job. And really what I like to pay attention to are the news consumers. You know, our democracy really relies upon a robust press being able to operate, that it's not just, you know, down to a few media conglomerates with even more decimated staff. Because the reality is if you don't have reporters who are paid appropriately, looking into and playing that watchdog role, I really worry about what that means for our country and the democracy writ large.
Do you think AI plays a role? Because Jonah, yes, he did reference AI, saying that AI is not going to replace any of these jobs, but they are committed to AI, and this is something that we know is going to disrupt not only media, but clearly almost every single industry out there.
Yeah, the AI question is the big one right now, right? How much will AI take jobs from journalists even? I think we've already seen early indications of that, of the introduction of AI does not eliminate the need for human beings to be involved. We saw a tech website employ AI as a way of writing articles, and then they had to go through and fact check and retract a lot of them. But perhaps another way of thinking of the AI question here is there are already tools that newsrooms are utilizing that have AI. One is transcription services, for instance. It used to be that you would record an interview and you would have to go through and manually transcribe. And now we do have AI to assist us, but a human still has to go through and verify it. And I think in journalism specifically, you know, I'm thinking not just content creation, but journalism, where you need to ensure that your facts are correct. What we've seen so far from AI, specifically ChatGPT, is it's prone to make errors and it's not always factually accurate. So I don't see the need to eliminate humans in the near future. And if you get rid of them, you might end up with a lot more problems.
Indeed. Let's commit to that. Elahi Azadi, we hope you are right. Great job. Washington Post. Appreciate that. The Oakland A's are rolling the dice, headed to Vegas. A's President Dave Cavall joins us on the other side of the break with details on the move. Going, gone. The Oakland A's betting big on Vegas, throwing down for a 49-acre plot of land near the Vegas Strip. A's President Dave Kaval joining us now with more on the big move. Dave, good to see you. Congrats on all this. I know it is a sad day for baseball fans in the Bay Area, but let's talk about Vegas. Tell us more about the move, about the acquisition, and the ballpark you plan to build.
Yeah, it's a big day, big milestone in Las Vegas, entering a purchase and sale agreement on 49 acres right next to T-Mobile, really just, a stone's throw from Allegiant Stadium in kind of the stadium district, a great location both for locals as well as tourists, and a great place to build a Major League Baseball stadium.
Tell us more about that ballpark, the dollar figure, how do you plan to pay for it, the type of capacity as well.
Yeah, it's going to be about 32,000 capacity stadium in a mixed-use development with bars and restaurants and nightlife around it. So it'll be a great attraction, not only on game days, but other days of the week as well. It's going to be a great location. We're looking at $1.5 billion in terms of its total cost, plus the land cost. And, we're investing over $1 billion in private capital, working with the folks in Nevada on a public-private partnership for the balance, and having good initial conversations to make that happen in a positive way.
Okay, Dave, so what needs to happen to make this official, and when can we expect the move?
2 steps. First of all, we need to finalize the public-private partnership and incentive package with Nevada, and those conversations are ongoing and been very positive. And secondly, we need to apply to Major League Baseball for relocation, and that's probably going to be in the second half of the year. Once that happens, then we could break ground next year and open this new stadium in 2027.
So you've got a lease through the 24 season at the ballpark you currently reside in Oakland. Can you break that early? Do you expect to play there for the remainder of the lease?
We're working on a plan in the interim period of where we're going to play, working closely with Major League Baseball. We have the ability to play here through 2024. We also could play at our minor league affiliate, our AAA stadium in Summerlin, which is a suburb of Las Vegas, for a couple of years. So there's a couple options that could work. And we want to make sure we work with baseball and with the players union to do that in a responsible way. Yeah,
there's a couple year gap in there, a bit of purgatory. Yep. So what are if you can't get in Vegas, which is where your AAA team is, and you can't stay in Oakland, is there another option? And what do you think is most likely if you are a betting man, which you are, because you're going to Vegas?
Well, I think it's hard to say yet. We got to take our lead from the league on how that works. We know we can play at the AAA facility. That's an agreement we have in place. And so that's certainly a possibility. And we know we can play here through 24. So we have some good options, and it's about making sure that we understand the timelines and have a plan that works for all parties. But we're very excited, and folks in Nevada have really welcomed us with open arms and are working hand in hand to make this happen.
So when you look at Sin City now, you got the Raiders, you've got the Aces, you've got the Desert Dogs and Golden Knights, a Pro Bowl, a Super Bowl, an NFL draft, a Final Four, Formula One, a national championship of college football. Dare I say it as I sit in New York, is this now the pro sports capital of the country?
Well, I think once the American pastime is there, it can be that. And, we're kind of that final piece to make that happen. It's just an incredible market, both in terms of the local fans who are very passionate about their sports, as well as the 45 million tourists. It's a great combination. That plus the resorts and casinos is just a great location for events and for teams. And we're very excited about the prospect.
A lot of fans in Vegas are wondering, is the business model going to change? Because it's no secret to you, A's attendance has plummeted in recent years, currently last in the league. The team's payroll is dead last. Your record, your run differential, last in the league. Can you blame the fans for not showing up? And will that business model change in Vegas where people expect to pay $300 for a bottle of vodka, $200 to get into a club, $500 for a steak dinner? They want the finer things in Vegas.
Well, we have a great track record of winning with not a lot of resources, Moneyball and things like that. If we have the additional revenue that comes with the new stadium in Las Vegas, we can invest that in the players, retain our talent, keep all these great young players that we've developed over the years. And so I think it really puts us in a strong position to compete for more world championships and to really put a great product on the field. So we're excited about that and that investment on the player side.
The folks in Oakland obviously sad and disappointed in their Mayor also said, it's clear to me the A's have no intention of staying in Oakland and have simply been using this process to extract a better deal out of Las Vegas. Was there anything they could have done to get you to stay?
You know, it's a sad day for our fans in Oakland and for the community. We understand this is a difficult time with the potential relocation. We've spent the last 6 years giving it our all to get this waterfront ballpark built. Spent $100 million of our own money for environmental reports and lawsuits and approvals and state bills. And people in Oakland have done an incredible job supporting us, the mayor, the fans, the current mayor, Shang Tao. But right now, we're looking at 7 or 8 years from when we could open a new building in Oakland at the waterfront. And there's still lawsuits and stuff that bring that under risk. And so we just don't have a path on a timeline that makes sense. And that's why we needed to focus on an alternative. And Las Vegas provides that. And that's why we're moving forward with that.
And the symbol of the A's, unfortunately, has become this possum that's reportedly living in the visiting broadcasting booth. Can you update us quickly on the possum's status?
Well, you know, obviously we have a facility that's 10 years past its useful life. It's one of the oldest facilities in the league. We're doing what we can with the stadium authority who owns the building, the JPA, to make sure that these things are taken care of. It's a full court press to ensure that, you know, these things don't happen anymore. But it's been a challenge because of the condition of the facility. And it's just another indication of why we need a new building and why we need to get this process moving to a successful conclusion as quickly as possible.
The Rally Possum has its own Twitter feed. A's president Dave Kaval, congratulations on the move to Las Vegas. Appreciate you joining us here on Yahoo
Thanks for
Finance.
having me, guys.
Thank you. Good luck. All right, coming up, we dive into some of the trending tickers moving after hours. Stick around.
Let's take a look at what's trending after hours. We got 4 stocks for you here. CSX Corp. We also have First Financial Bancorp, PPG, and Clorox. Kicking off with CSX Corp, the railroad operator, out with results here. The stock moving to the upside, up just about 3% here in extended trading. The company beating on both the top and bottom lines, driven by higher volumes from its merchandise and coal divisions. There also the higher fuel surcharge really helping the results. You can see year to date the stock just barely in the red. On a 1-year basis, the stock off just about 12%. Let's kick it over to First Financial Bancorp. That stock also on the move here after hours. You can see it up just about 3.7% right now in after hours trading. Now, this is a regional bank headquartered in Cincinnati here. The profit beat expectations. Also, total deposits was better than expected. We know such a critical number here, obviously. That's always the case, but very much in focus following the collapse of Silicon Valley Bank and Signature Bank back in March. So taking a look at that number, that coming in better than expected, $12.81 billion. First Financial Bancorp was caught up a little bit in the selling that we did see throughout the regionals in the month of March. But again, in extended hours, up just about 3.7%. Flipping over to PPG, the manufacturer there, that stock up just about 2% here in extended trading. The paint and stain brands, that is what the company is known for here. Pretty solid numbers here, but it's all about the forecast when it comes to PPG. Second quarter profit forecast, and actually its full year profit forecast was also much higher than what the street was looking for here. Net sales of $4.38 billion was also a beat. And rounding it out with Clorox, the company cutting jobs, not much movement here after hours, but the company announcing that it is cutting 200 positions. The second round of layoffs here for Clorox as the company really adjusts its business here, trying to improve margins, trying to get it back to the levels that we saw pre-pandemic. The company has raised prices a couple of times to deal with higher production costs. So trying to navigate a very, very tough time over the last 5 days. The stock up just about 2.5%, Dave.
Okay, Shauna, thank you. It is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. It's been quite a ride for Elon Musk. First up, Musk in his role as CEO of Tesla saw his company's shares close nearly 10% lower after the EV maker's first quarter earnings results missed estimates, with recent price cuts denting Tesla's margins. As a result, at least 8 Wall Street firms cut their price targets on the stock today.
Then Musk, in the role of CEO of SpaceX, saw his Starship rocket launch only to see it explode shortly after. The most powerful rocket ever built, Starship did successfully make it off the launch pad, but it was about 4 minutes into its flight when it exploded over the Gulf of Mexico. There was no one on board. SpaceX putting a positive spin on the launch, tweeting, quote, "As if the flight test was not exciting enough, Starship experienced a rapid, unscheduled disassembly before stage separation."
And finally, digital media outlet BuzzFeed is cutting 15% of its staff. It will also be shuttering its Pulitzer Prize winning news division. In a memo obtained by Yahoo Finance, CEO Jonah Peretti blaming several factors, including a tech recession and the pandemic. BuzzFeed shares closed nearly 20% lower on the news.
All right, well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. Have a good night.